Hey guys.
Hello.
I figured out how to free up more room on the cloud for Zoom recordings. I'm putting them on YouTube now. I just started with one from I had a finance class Zoom meeting last night. So I got uploaded to YouTube today. And so I gave everybody the YouTube link. I'm hoping that's going to work out okay anyhow. So that way I don't have to worry, because otherwise, you know, with the cloud storage that Zoom gives you, they only let you have so much if you don't pay for more money. And yeah, that's going to work. Screen here. Okay. Oh, we'll wait a couple more minutes for others to join. And you realize after tonight, we're 60% of the way done with this course. Yeah, these 5 weekers go fast, don't they? They go really fast. Okay, Jean-Pierre is joining us. Give it about another 30 seconds or so before see if anybody else is joining. Meanwhile,
I spent so long worried that she was going to hurt people, but now turns out people would rather hang out with my villainous alter ego.
Where are we messing? Oh, my other class. There. That's the other class. There. I'll get things in the right pile. Oh. Ellen's on, Jean-Pierre is on. Anybody else to admit? Simon, don't have Simon on yet. Rachel's on. Keith, don't have Keith on yet. Oh, there's Keith. I'm sorry, Keith. Yeah, we got you. Matt's on. Taylor's on. Okay. Sarah's on. James is on. Sam, we don't see Sam yet. Show. I guess that's it. Sam and Show and Simon. We're all missing so far. All right, well, we'll go ahead and start. Maybe we'll luck out and even get done early tonight. That'd be cool, wouldn't it? Yeah. I'd like that. I don't know if you guys would. So I think I had already mentioned the test. I'll set it up for you guys to take it anytime beginning at 8 o'clock Friday morning up until it has to be turned in by midnight Saturday night, right? And I said, once you start, you have a 3-hour time. So that's, and I don't know if you noticed, I did put a review on there today for test 1. So that's pretty much going to cover everything you would expect to see on the test. And in fact, I think for the lecture, I'll just go through the review portion of things that, you know, we haven't yet covered and call it good. So let's see, I'm going to do this. And you guys let me know if all of a sudden, like, okay, I'm gonna go back to the kind of a thing and move that over here. If all of a sudden, like, something shows up on the screen saying there's people in the waiting room and I'm busy talking and I don't notice, will you guys point it out to me, please? Okay, so review for test 1 and that. And here we go. So I got each of the 7 chapters. Remember, test 1 covers the first 7 chapters. Okay, I see it pop up. Sam's here now. Okay, so now we're only missing Simon and Show. Anyhow, I did a little review thing here for each of our 5 chapters. Why can't I see it down? So chapter 4, of course, remember, said, well, that's just a very basic review of accounting, so we didn't spend any class time with that. Chapter 5 we covered last time. I didn't cover it in exactly the same order or way that I have it on here, so maybe real quick we'll just run through a super fast review of chapter 5 again, and then we'll get into chapters 6 and 7. And pull my notes out for it, but I do wouldn't mind covering chapter 8 tonight too, if we can. Even though you know, and chapter 8 will not be on test 1. That'll put us, you know, we'll be through the first 7 chapters for test 1, plus 1 additional chapter if we can get through chapter 8 tonight. And then we'll be in great shape for those last 2 classes that we have. So again, getting back to chapter 5, I don't think I mentioned this last time, that diluted earnings per share is the more important number than basic earnings per share. I don't know if you guys remember the difference from, you know, if it was talked about in accounting 2 or in your finance course, probably should have been if it wasn't. But the difference is essentially this. Basic earnings per share is the earnings per share based on the number of shares currently outstanding, and then diluted earnings per share is based on the number of shares that could be outstanding if everything, if everything that could be become a share of stock did become a share of stock, like convertible bonds, if they got converted into stock, or if there's stock options or stock warrants. Okay, we're at 100%. Everybody's here. So, so that's the difference. Again, basic earnings per share is the earnings per share you have based on the number of shares actually currently outstanding. Yeah, okay, somebody's talking to me. I'm going to scroll through, try to find who was talking to me. Oh, nobody? Okay, maybe it was background noise. I thought I heard my name. Okay, I'll scroll back and forth through this just so I can kind of pick up if anybody, you know, seems to be every couple minutes I'll scroll down to see different faces, see if anybody seems to be puzzled or anything like that. You know, after 35 years, you get to be kind of an expert at reading faces. So I know when people are pissed off. I know when they're, I know when they're puzzled, et cetera, et cetera. It's a good thing to know. All right. So again, diluted earnings per share is what you would have if everything that could become a share of stock did. And that's more important than basic earnings per share, which again is earnings per share based on the current number of shares. Okay. We mentioned this last time, watch for big increases in accounts receivable. Might mean that the company juiced its sales a little bit by easing credit policies or credit terms with customers to try to meet certain sales goals and whatnot. Watch big increases in inventory because, again, if inventory gets too large, it may have to be written off, or sold at a large discount. Remember, cash flows are important. It's not just all about earnings. We mentioned be wary of companies that seem to always have non-recurring charges, because if they always have them, then they're not really non-recurring, right? And we mentioned that debt is the cheapest form of financing. I list the reasons here because bondholders are taking less risk than stockholders, because stockholders are the last to get paid. So because they're taking less risk, they're not going to require as high a rate of return. And of course, interest expense paid on bonds is tax deductible, unlike dividends paid on stock. But while it's your cheapest form of financing, remember we also said, well, it's your most risky, because your interest and any principal due have to be paid, or if they're not, the company is in default and could be forced into bankruptcy. So that's just kind of a quickie overview of what we hit in chapter 5, or at least most of what we hit in chapter 5. Any questions on that at all?
Bro,
Jean-Claude? Yes.
Yes, the difference
Between basic earnings per share and diluted. Is that right, Jean-Pierre? Yeah, okay. So again, basic earnings per share is based on the number of shares currently outstanding, whereas a diluted earnings per share is based on the number of shares that would be outstanding if everything that could become a share of stock did. So for instance, if a company issues convertible bonds, that means those bonds can be convertible into shares of stock, which obviously affects the number of shares outstanding. On top of that, since bonds are a form of interest-bearing debt, it's also going to affect income, so it's going to affect earnings per share. If there's stock options that have been issued to management, and management hasn't exercised those yet, but they could be converted into share, or could be exercised and turned into shares of stock, that will change the number of shares outstanding. So again, diluted earnings per share is the earnings per share that you would have if everything that could become stock did. Okay, Jean-Pierre? All right, anybody else? Any other questions? Anyway. All right, well then we'll move into chapter 6 on analyzing a company. That's actually a pretty meaty chapter. They talk about, first of all, analyzing growth of a company. And an interesting fact, oops, all of a sudden, my mouse quit working. Oh, give me just a second here. I'm trying to, I can use my finger to move it on the thing, but I prefer to use the mouse. For some reason, the mouse isn't working. Anyhow, that's fine. As you can see under growth there, he states in the chapter that historically, aggregate growth in corporate profits has been just slightly below the growth of the economy. Now, to me, though, since the economy is measuring, all goods and products, the value of all goods and products produced within the U.S. borders over, a period of time, it's always annualized, but it's measured on a quarterly basis. So here at the end of June 30th, that'll end the second quarter of the year. and then we'll get economists will tell us by late July how much, at least based on initial estimates, how much the economy grew, or obviously in this case, shrank from the previous quarter. But anyhow, when they say that, I have to believe that he's not talking about just real growth in the economy, but instead is talking, total growth in the economy. What's the difference between real growth and what's the word I'm looking for? Other than real growth?
Nominal.
Thank you. That's the word I was looking for. Yeah. Was that you, Matt? No. Sam?
James.
James. Okay. Thanks, James. Yeah. Okay. Nominal growth. What's the difference between nominal growth in the economy and real growth? Inflation. So, for instance, if an economy has a nominal growth rate of 5%, meaning the value of all goods and services produced went up 5%, but the inflation rate is, say, 2%, then that means, okay, well, 2% of the increase in the value of goods and services produced was just because of higher prices, not because of more economic output. So if the nominal growth rate is 5%, and inflation is 2%, then of course the real growth in the economy is 3%. So when they say growth in corporate profits is slightly below the growth of the economy, I have to believe that's based on nominal economic growth rather than real economic growth, okay? Because I know that if you go back, to like 1926, earnings, the annual growth rate in earnings has been around 5% annually, but that has not been the real economic growth rate. That's been closer to 3% annually. So that's why I think they must be, when he says that, he must be talking about the nominal growth rate. High quality, I'm still trying to get my thing to work. Why does it not work? Even my battery's about dead. But that's what it is. Sorry, guys. I know I get distracted by these little things because I'm like kind of OCD. Hey, I think I saw it. Did I? No. Oh, I did not. Okay. I don't know. All I can think is yeah. Okay. Maybe it's a bad battery. I don't know. Okay. Then he talks about high quality earnings growth versus low quality earnings growth. So of course, high quality earnings growth comes from increasing sales by selling more goods and services. Now there's other ways to increase sales as well. We'll talk about here in a minute, but but that's high quality growth. So every quarter, as you guys are probably well aware, every quarter a company will release its quarterly financials. And when they do that, they're going to announce what the sales for the quarter were. They're going to announce what the earnings and earnings per share for the quarter were. And then a lot of companies will also give forward guidance in terms of what they expect sales and earnings to be in future quarters. Okay, so when investors see those, when those reports come out, a lot of times it can have a major impact on the price of the stock. But they're not just looking at what happened to earnings. Did earnings meet or beat expectations, or did it fall short of expectations? But they're also looking at sales. And they're also looking, more than anything, at forward guidance. That's what they look at most. But of course, if earnings grew, but sales didn't grow, then a lot of times investors will be disappointed, because long term, the only way you're going to grow earnings is to grow sales. You can grow earnings short term without growing your sales, and we'll talk about some of those things. But long term, the only way you can grow earnings is to grow. So again, high quality earnings growth comes from selling more goods or services, and then low quality earnings growth comes from cost cutting or from accounting tricks. Okay, so yeah, you can cut costs. Oh, I see. I put form instead of from. Sorry, my OCD again. Okay, there. All right. Low quality earnings growth comes from cost cutting rather than sales growth. And, you know, it's not that it's a bad thing to cut costs, but there's only so much fat you can cut out of the budget. Right? I mean, sooner or later, you can't keep cutting costs and remain competitive within your industry. So temporarily, yeah, you can grow earnings without growing your sales. Long term, though, if you're going to grow earnings, you need to grow. Now, this is one that was not in the book here. This internal growth rate, which equals the return on equity times one. Oh, what? No, I guess not. I was going to say I got that right there, but here, let me. Okay. No, thought I had my. Oh, I do have my mouse back. Yes. Woo. That just bugs me when things aren't working the way they're supposed to. Okay. So the internal growth rate in earnings is something he did not talk about this in the book, but I do want you to know. Okay. And the internal growth rate is going to equal your return. Technically, it's your return on beginning equity times 1 minus the dividend payout ratio. So let me show you an example of that. Let me go to a Word, open a Word document here. And okay, so let's say my beginning equity is, I don't know, let's just say $1 million. Nice round number. Okay. Now, let's say my return on that equity is, let's say 10%, another nice round number. Of course, you guys tell me how much is my net income. If my beginning equity is $1 million and my return on beginning equity is 10%, then of course, what's my net income? Sam, tell me. Sam, you there? I'm gonna look for Sam now. Sam, you're there getting your massage again.
I'm thinking.
What'd you do, fall asleep?
No, I'm just trying to think.
You're just trying to think. Well, 10% of $1 million is 100,000.
Yeah.
Yeah, kind of thought you'd pop that off the top of your head, but that's all right. Hey, it's late in the day, right? Okay, so that would be your net income based on a return on beginning equity of 10% and a beginning equity figure of $1 million. Your net income would be 10% of that, or 100,000. Now, let's say that I'll just abbreviate it, DPO, dividend payout ratio, is 40%. What that means then is you're going to pay 40% of those earnings in dividends, and 1 minus 40%, or the other 60% of those earnings, would be retained in the company. So of course, your dividends, if it's 40% of 100,000, chance to redeem yourself, Sam, 40% of 100,000 is?
40,000, sorry.
Thank you. I knew you knew it. I'm like, come on, Sam, I know you know it. Okay, 40,000. So, what was my increase in retained earnings, which of course is a stockholder's equity account? If my dividends were 40,000, what do I got to do? My increase in retained earnings and my net income, by the way, was 100,000. How much was was my increase in retained earnings. Well, must have gone up by 60,000, right? Joe, I'll let you answer the next question or two. Okay? On your toes. Okay. So increase in retained earnings. So if you retained earnings again goes up by the amount of income the company has, less any dividends paid out. So if we have 100,000 of income and we paid out 40,000 in dividends, all right, that's going to give us an increase in retained earnings of 60,000. So since that's a stockholders' equity account, what is our ending equity figure, Joe? The beginning was $1 million.
Mm-hmm.
Now we know that retained earnings went up 60,000, so ending has to be
1,060,000.
exactly 1,060,000. Well, of
Yes.
course, yeah. So obviously, then that becomes the beginning stockholders' equity for the next year, 1,060,000. Okay. So now, if the next year we continue to earn a 10% return on beginning equity, what is our net income going to be the next year? Well, what's 10% of 1,060,000? Show.
It's about 106,000.
Yeah.
Is
So
that right?
106,000. Yeah. Okay. So, yeah, 10% of any number, just lop off the last digit. That's your number. So, yeah. Okay. So it's $106,000. So how much did my earnings grow? Taylor, we never get to see Taylor. She never shows us herself, but she's on. So Taylor, tell us, what was the growth rate in earnings then from 1 year to the next?
6,000.
6,000, or of course 6%, right? That's a 6% growth rate in net income, which is the same thing you would get if we took, again, that return on equity, beginning equity of 10%, and then you multiply that by 1 minus the dividend payout ratio of 40%. That's okay. Well, 1 minus 40% means 60% of the earnings are retained in the company. So if your return on equity is 10% and 60% of that is going to be added to equity, then your internal growth rate is 6%. Okay. Should I save that? Maybe I'll save that. Put it on there because save as internal growth. All right. So got that saved. So that's how you find the internal growth rate. Again, it's return on beginning equity times 1 minus the dividend payout. Okay. Let's see it again there. I'll put this online when we're done tonight. Okay. So now, of course, a lot of assumptions go into that. One, we don't really know, just because return on beginning equity was 10% 1 year does not automatically mean it's going to be 10% the next year. Just because the dividend payout ratio was 40% 1 year does not automatically mean the same percent of earnings will be paid out in dividends the next year. And of course, it also assumes there were no other changes in stockholders' equity, like from any stock being issued or any stock being repurchased. So there's a lot of assumptions that go into that internal growth rate. In fact, let me put it here. Internal growth rate. Okay. So a lot of assumptions go into that internal growth rate. But if all those assumptions were true, that would be our annual growth rate in earnings. It would equal the return on beginning equity times 1 minus dividend payout ratio. So in this case, 10% times 1 minus 40% dividend payout ratio, or 6%. And as we can see, that's exactly the amount by which net income grew, because that's the amount by which equity grew from the beginning to the end of the year. So, make sense? Yeah? Okay. Okay. All right. Yeah. Okay. All right. Sam, how come you guys pop up on my, you're on my last screen and my first screen? How's that happen? I don't know. Okay. Anyhow, all right. So let me go ahead and minimize that and get back to this. Okay. So that was the internal growth rate. Now, sales growth. So we said again, high quality earnings growth comes from sales growth. Well, again, there's some, there's various ways of growing sales. You could simply grow more, or sell, I should say, more goods or services. Okay. Why are you selling more goods and services? Maybe it's a growing market, or maybe you entered some new markets, or maybe the market's not growing and you didn't enter any new markets, but you're just taking market share away from existing competitors. Okay, I mean, it could be any of those things, right? So sales growth could come from selling more goods and services. It could also come from not selling more goods and services, but just raising the price on the goods you do sell. So you're not selling more goods, but the goods you are selling, you're selling at a higher price, which gives you a higher dollar amount of sales. Okay, you can also sell new goods or services that you haven't sold in the past. And another way to grow sales is acquisitions, because of course, when you acquire another company, their sales become your sales, their earnings become your earnings. Okay. Now, generally speaking, most investors, most analysts don't tend to like real acquisitive companies. That doesn't mean they hate all acquisitions. You know, some acquisitions are good acquisitions. Sometimes, when a company makes an acquisition, investors in the acquiring company are actually happy about it. Sometimes. A lot of times they're confused, they're puzzled, and they're not happy about it, just depending on the acquisition and who they bought, what the price was, et cetera. If we go back years ago, I know when Google bought, who was the hardware that they, Motorola. Google bought Motorola. And analysts were super puzzled by that. They're going, number one, Google is in the software business. Software grows a lot faster than hardware. Motorola is in the hardware business. Number two, software has a lot higher profit margins than hardware. And again, Google's in the software business. Motorola is in the hardware business. So they're like, why would they do this? And so analysts were kind of scratching their heads. Why does a high growth, high margin business all of a sudden spend, I think it was at the time, 12, and this was years ago when, $12 billion was nothing to sneeze at, so they paid $12 billion to buy Motorola, and everybody's like, why did they do that? Why does a rapidly growing, high margin business want to buy a slow growing, low margin business? And it turns out, the thinking at least was that Motorola had a lot of patents that they wanted to acquire. So it was really not so much for the company itself as the patents that the company owned, because Motorola actually owned, I guess, hundreds, maybe thousands of different patents. And that's why Motorola wanted to acquire. Anyhow, More recent example, Amazon buying Whole Foods. Like, okay, Amazon's growing rapidly, Whole Foods not so much. Amazon, high margin, Whole Foods, being a brick and mortar retailer, not as high margin. Why do they do that, And again, I guess they figured, well, they've got their reasons. They say, Jeff Bezos isn't a dumb guy. It seems like if he did it, he must have a good reason for doing it. Certainly, part of it is they already had plenty of data on the shopping habits of online buyers. By owning Whole Foods, they could now acquire a lot of data on in-store buyers. They could also display their products, like the Amazon Echo and things like that in store. But anyhow, a lot of times acquisitions do fail to produce any real shareholder value for the acquiring company. A lot of them don't work out. Acquisitive firms that aren't just making the occasional acquisition, but are constantly acquiring other companies. Acquisitive firms, generally, again, investors, analysts don't like them because they become complex. They become hard to analyze over time because, well, gee, how much do you see? Oh, wow, this company's sales has been skyrocketing every year. Well, if the only reason the sales and earnings are skyrocketing is because they keep buying new companies and acquiring their sales and their earnings, are they buying them at a price that is actually generating benefits and adding value for existing shareholders of the company? And that's a major question mark. And again, it becomes very hard to analyze over time. Well, how much of the growth is really what you might consider organic growth versus how much of that growth comes from just acquisitions, The other thing, the energy of the managers in acquisitive firms are going toward acquisitions rather than spending their energy on running the core business. So, I guess not that all acquisitions are bad. I'm not trying to send that message, nor is the author. But I do think the author, as well as myself, are trying to send the message that, okay, a good strategic acquisition now and then, a bolt-on acquisition that makes sense for the company at the right price, et cetera, is maybe a good thing. But too many acquisitions over time is usually not a good thing. And investors don't like them. Okay, now, next we can talk about earnings growth, because up to now we've just been talking primarily about sales growth, although we did mention earnings growth in the first couple of lines there. But how can you have earnings growth without sales growth? And like they list, well, there could be lower tax rates. A lot of companies, if you look, there was the new tax law was passed in December of 2017. And actually, because it was passed in December of 2017, it actually did affect the earnings of a lot of companies in 2017, even though the new tax rates didn't go into effect until 2018. Why? Because it meant that a lot of overseas earnings were going to be taxed as if they were repatriated. That was part of that tax law. And also because it changed the corporate tax rate from 35% down to 21%, it meant that companies that had deferred tax assets, all of a sudden those assets aren't worth as much at a 21% rate as they were at a 35% rate. So they had to take a write-off or a hit to earnings on those assets. On the other hand, companies who had deferred tax liabilities, well, those liabilities aren't as great at a 21% rate as they are to 35% rate. So they actually got to take a one-time gain from that. So anyhow, but certainly, you know, you do want to look at, well, did the earnings grow just because the tax rate went down? That's not something the company itself has a lot of direct control over. Did earnings per share increase only because the number of shares outstanding decreased? Because, you know, as we know, a lot of companies buy back stocks. So if you're buying back stocks, you know, your number of shares outstanding go down. So the earnings per share is going to have a tendency to go up. Could be pension gains, or right below that, other one-time gains, like gains on discontinued operations, or again, like I mentioned, one-time gains that a lot of companies had when their deferred tax liabilities got to be reduced because of the change in tax rate. And of course, cost cutting. Obviously, if you cut your expenses, you can grow your earnings even if your sales don't. So those are all ways of growing earnings without sales growth. I did throw this in. This isn't in the book, but do you guys remember when we talked about operating leverage in financial management? Do you remember that at all? So in finance, you should have talked about operating leverage and also financial leverage. Yeah. Financial leverage just referred to the use of debt versus equity financing. Operating leverage involves the use of fixed costs versus variable costs in your operations. Of course, fixed costs, remember, those costs that don't go up as your sales grow, right? So, so with operating leverage, as your sales are growing, your fixed costs are going to stay the same. So now they're being spread over more sales, and profit margins can go up with growing sales just because of those fixed operating costs. Does that make sense? Yeah, kinda, sorta. Nobody's, okay, I'm looking at Helen. Helen, does that make sense?
Yes, it does.
Okay, okay. Rachel, you're right below Helen on my screen. By the way, do you guys see the same people I see? Are you guys seeing Helen and then Rachel and then Jean-Pierre and then Simon? No, you guys, oh, it's different on your screen. Oh, okay. I didn't know. All right, yeah, so again, those fixed costs don't go up when sales go up. So if sales are growing, your costs are going to grow, but they may not grow at the same rate as your sales because of those fixed costs. Okay. So that's operating leverage. Okay, let me move. Get my over here. All right, so that's growth. That's everything with regard to analyzing a company's growth. At least everything I was going to talk about. Profitability. I want to mention a few key ratios with regard to profitability. Of course, we're all familiar with the return on assets, which is net income divided by total assets. But remember, there's also that DuPont formula that says, well, we can find that same figure by taking the net profit margin of the company and multiplying it by the total asset turnover ratio for the company. Okay, so your profit margin, again, is net income over sales. If you then multiply that by the asset turnover ratio, which is sales over total assets, that's your return on assets. So in other words, the return on assets is partly a function of this right here, the sales over total assets, the asset turnover ratio. In other words, how many sales do I generate with my asset? But then it's also determined by how much of those sales are then converted to net income. Okay, how much of those sales are then converted to net income? So it's affected by both the asset turnover ratio and the profit margin. The higher those two ratios, the higher your return on assets. Okay, that's why one company may have a lower profit margin than another. Take, for example, Walmart. Okay. Walmart has generally, at least historically, I know, had a lower profit margin than, say, Target did historically. Not every year, most years. Okay. Why? Well, because they sell at lower prices. But at the same time, most years, while they had a lower profit margin, they still had a higher return on assets. Why? Because they made up for it with volume. They sold in higher quantities relative to their assets than did Target. So they ended up generating a higher return on assets. Return on equity is the return on assets times the financial leverage ratio. Okay, so what do we mean by the financial leverage ratio? Financial leverage ratio is total assets divided by stockholders' equity. In other words, remember, what do assets equal? What did you learn day one of accounting? Assets equal what? Liabilities plus stockholders' equity, right? Yeah, exactly. So if total assets divided by stockholders' equity is a high number, that means then you are financing most of the company with debt rather than equity. For example, if your total assets were 4 times stockholders' equity, you could flip that around and say, oh, okay, so then stockholders' equity is only 1/4 of my total assets. So if stockholders' equity finances 1/4 of my total assets, then obviously liabilities have to finance the other 3/4 of my assets. And of course, we know one of the ways of generating a high return on equity is using a lot of debt financing. So you don't have as much equity. Okay. Now, in this chapter, he says, well, return on equity greater than 10% without too much leverage is good. But you know what? If I scroll back to a previous chapter, the moat chapter, which was chapter 3, in chapter 3, he said a return on equity greater than or equal to 15% is kind of a rule of thumb for companies with an economic moat. But then down here, he's saying, well, if it's greater than 10% and the company hasn't used too much leverage, in other words, too much debt, that's good. Okay. All right, let's change our screen around a bit here. Okay. All right. Free cash flows to equity. He just calls them in the book free cash flows. Technically, it's free cash flows to equity. Is the most common formula is this one. It's your operating cash flows. Cash flows, remember, from the normal operations of the business, minus CapEx, capital expenditures for plant and equipment. Okay. So he says, well, if you have free cash flows to equity greater than or equal to 5% of sales, generally that's good. Okay, and he did say use that same figure back in the moat chapter 2. All right. This is a new one. You guys, we don't really talk about this ratio in other courses, but it is one that is looked at a lot. Return on invested capital. Return on invested capital, which can be found by taking NOPAT divided by invested capital. Now, what do we mean by NOPAT? NOPAT stands for net operating profit after taxes. Okay, as I define right here. And you can find it by taking earnings before interest and taxes and then multiplying by 1 minus the tax rate. That would be your net operating profit after taxes. So it excludes interest expense. Okay. invested capital, and why does it exclude interest expense? Because that's a financing cost, okay? Now, invested capital equals total assets minus any non-interest bearing current liabilities, because non-interest bearing current liabilities is basically free financing for a company, right? What would an example be? Accounts payable. Accounts payable is really free financing given to us by our suppliers, right? So that allows us to own inventory that we haven't paid for yet. So that's why we would subtract that out, because that's free. We wouldn't consider that as part of our invested capital, because that's free capital given to us by our suppliers. Okay, so it's total assets less non-interest bearing current liabilities and minus excess cash. Why do they subtract excess cash? That one I'm personally a little bit like, well, I don't know if they should do that, because, you know, it's still cash had to be supplied by either the equity, which belongs to the stockholders, or by debt, which is liabilities. So I'm like, but I think the reason they do that is they assume excess cash could just be given right back to shareholders, either as dividends or in the form of a share repurchase, where the company just buys back shares. Okay, they're like, okay, well, that excess cash, we don't really consider that part of our invested capital, because that's money that could just be given right back to shareholders in the form of dividends or share repurchase. So it's all the money invested in the assets, less any excess cash. It could just be paid out to shareholders, and less the non-interest bearing current liabilities, which is free financing. That's our invested capital. Okay. You take the NOPAT, net operating profit after taxes, divided by invested capital. That's our return on invested capital. You want that to exceed your weighted average cost of capital over time. Okay. So the thinking is, well, certainly remember the weighted average cost of capital, which you may remember from finance, is the weighted average cost of all sources of financing combined, both debt and equity. And so, okay, you want to make sure that the return on the invested capital exceeds the cost of that invested capital. So you want to make sure the return on invested capital equals or exceeds the weighted average cost of capital. And that's it for the profitability ratios. I do want to go back and hit something else on this return on invested capital. By the way, it's kind of hitting me now because this is such a meaty chapter. We may not hit chapter 8 tonight. If we don't, I'm gonna still sleep at night. Hopefully you guys don't lose any sleep over that. Okay. So here's what I want to do. I know what I want to do. I'm going to minimize this momentarily. Go into content here. And I don't know, any of you guys check out these, I've got some Wall Street Journal articles here that I pulled them all from when I was doing the course back in 2016, but they're pretty much still pertinent today. This one maybe not so much. I'm probably just could remove that one. Here's the one though on return on invested capital. So if we download that, you can see that, and I got it through ProQuest. Okay. Really starts about here where they say, last year, General Motors fended off a group of activist investors with the help of an esoteric financial metric to which it had previously paid little heed. The century-old automaker began publicly touting the statistic known as return on invested capital, or ROIC. It tied compensation, this is management compensation, to a 20% target and said that above a $20 billion cushion, cash on which it couldn't earn that return would be handed back to shareholders. And the steps placated the activists. So like they go on to say, GM's move underscores much as a financial metric can be, return on invested capital is all the rage. The popularity of the figure also is more evidence of the influence activists have come to wield in boardrooms. For ROIC lovers, which also include traditional stock pickers, measure is the best way to distill what activists view as the most critical skill of management, how they allocate capital. And then they go on to say the typical ROIC equation divides a company's operating income adjusted for its tax rate by total debt plus shareholder equity minus cash. Well, that's close to what our book says. Our book says, well, total assets minus non-interest bearing debt, okay, and minus excess cash. So very similar denominators. So there's not just one way to do it. So it aims to show how much new cash is generated from capital investments, on and on and on. By the way, they mentioned there are different pronunciations of it too. Some just call it ROIC, others call it ROIC, you know, I don't know, whatever fits your fancy, I guess. But anyhow, I'm not going to read the whole article, but you can see that that it is a metric that a lot of companies consider to be a very important metric. Okay, well, back to our thing here then. All right, so any questions so far? We covered growth and profitability. Next is financial health. Any questions so far? Sam's done with his massage. He's rolling over. All right. Financial health. So of course, with financial health, we're looking primarily at the balance sheet, although a couple of these ratios do involve income statement figures as well. Excuse me. So we already mentioned the leverage ratio. Remember, the leverage ratio up here is total assets divided by stockholders' equity. Leverage ratios greater than 4 to 5 times should be avoided. Okay, that means okay, because again, if the leverage ratio exactly equaled 4, that means assets are 4 times as great as equity. So equity is financing 1/4 or 25% of your assets. Liabilities then are financing 3/4 or 75% of the assets. If the leverage ratio was 5 times, assets are 5 times equity, then stockholders' equity finances only 1/5 or 20% of your assets. That means 80% of the assets are financed with debt. You get more than 75 or 80% of a company's assets financed with debt. Generally, you want to avoid investing in companies. By the way, in another course, financial management, we looked at a company that has negative stockholders' equity that stockholders are still clamoring to buy. Anyone remember what that company was? Anyone know? Well, let me scroll back through my pictures here. If you had me for financial management, we had a financial analysis assignment. And one of the questions was, how is it that this company's stockholders' equity keeps going down, even though they're a profitable company? And of course, what it was is they've been buying back a ton of stock. It was Home Depot. If you look at Home Depot, you can't even compute a meaningful leverage ratio because their equity is negative. Yeah, really odd. But anyhow, it does make it a little confusing in terms of trying to figure out, whether the company is healthy or not. Debt to equity is generally, most sources use the same formula as our book, which is long-term debt divided by stockholders' equity. Okay, the higher that is, the more risky the company is. Times interest earned. That's EBIT, earnings before interest and taxes, divided by interest expense. So the more times you can cover interest expense with your operating profit, the better. All right. Debt to EBITDA. This is not in the book, but this is one I've read a lot of Wall Street Journal articles and annual reports and things like that, or company releases where companies have talked about their debt to EBITDA, and so they're primarily looking in most cases only at interest-bearing debt, and then they divide that by EBITDA. Remember, EBITDA or EBITDA, whichever way you want to call it. EBITDA is earnings before interest and taxes, and then the DA stands for depreciation and amortization. You add back in depreciation and amortization expense because they're non-cash expenses. They get added back to your operating profit. It's kind of a rough measure of operating cash flow, I guess you could say. And so what is your interest-bearing debt as a multiple of EBITDA? And if it's greater than, and again, this is not in the book, but I just did a Google to see what's going to come up if I Google, when does debt to EBITDA become problematic? They said, well, at least one of the sources, the first source that came up, said if it gets above 4 to 5 times, so kind of the same with the leverage ratio. Okay, except this is now the leverage ratio is entirely based on the balance sheet. This is based on the balance sheet, which shows your debt, and the income statement, which is where the EBITDA comes from, right? Okay, so if it's greater than 4 or 5 times, could be a problem. Okay. Oh, I wonder what. So the leverage ratio can't even be computed for Home Depot, but I wonder about their debt to EBITDA. I know this. If you look at the debt ratings for Home Depot, they actually are rated investment grade, even though they have negative equity. So that's probably one of the ratios they're looking at. Hey, I'm a curious sort, as I'm sure you guys are too, right? So let's just look and see here at, we'll go to sec.gov. Let's look at Home Depot real quick. Okay, filings and company filing search. Okay, then HD for Home Depot. Go to the most recent 10K, which is right here. Okay. And then I'll scroll down to their financials, financial statements. Click there, scroll down. Here's the balance sheets. Okay, I'm going to minimize us for a minute here. Okay. Here's the balance sheets. All right, so as of February 2nd, 2020, the end of the most recent fiscal year, how much interest-bearing debt did they have? Well, the only interest-bearing debt would be the short-term debt, okay, the current installments of long-term debt, and the long-term debt. You could include long-term operating lease liabilities too, I guess. I can't honestly tell you whether most sources include that or exclude it, but I would say, well, it should probably be included to err on the conservative side as part of your debt. So if we take long-term operating liabilities, I'm doing this on my calculator right now. Okay, I got 5066 plus, I'm going to add in long-term debt excluding current installments of 28,670 plus, I'm going to add in the current installments of long-term debt of 1839 plus, I'm going to add in my short-term debt of 974. I get a total of 36,549. Now let's divide that by EBITDA. So to find our EBITDA, let's go to the income statement here. EBIT would be the operating income here of 15,843. But then let's see, 36,549 as interest-bearing debt if we count the operating lease, long-term operating lease liability. And then we got operating income 15,843. We have to add back to that our depreciation and amortization expense of 1989 to get EBITDA. So EBIT again, where was it? Oops, operating income 15,843 plus I'm going to add back in my depreciation and amortization of 1989. I get 17,832. So if I divide 36,549 by 17,832, I get about 2.05 times, we'll call it. Not bad. So, on the one hand, let's get everybody back on our screen again. So on the one hand, we have everybody. There we go. On the one hand, if you look at the leverage ratio, you'd say, oh yeah, you should avoid Home Depot because you can't even compute a leverage ratio because their equity is negative. But if you're worried about them being overly leveraged, and then you look at, well, what's their debt to EBITDA? It's just barely over 2 times, and it's really not a problem until it gets to be 4 or 5 times. We'd say, well then they're okay. And that also would explain why they get an investment grade rating. If you go to to look up their ratings by Standard & Poor's or Moody's, I can't remember what it is, but it's at least BBB. Maybe even a little better than that. Okay, so let's go back now to our sheet here, and we'll go back to this view. All right, debt to EBITDA. Current ratio, remember current assets over current liabilities. The author says, well, anything above 1.5 is good. I would concur, I would agree with that. Then we have the quick ratio. Remember the quick ratio is current assets minus inventory divided by current liabilities. Of course, why subtract inventory from the current assets? Well, what's our least liquid of our major current assets? Inventory, right? Because inventory has to be sold, and then if it's sold on credit, it becomes part of accounts receivable before it ever becomes cash that we could then use to pay off current liabilities. So that's why the quick ratio subtracts inventory from current assets. It's saying, okay, then if we just leave the most liquid current assets, cash, accounts receivable, marketable securities, how many times could we cover our current liabilities? Author says anything equal to or greater than 1 is good. I would agree with that. And then I added this too, that realize all of these ratios also need to be considered along with the stability of sales and earnings and cash. So in other words, you're not going to be as worried about high leverage ratios or low liquidity ratios for a company whose sales, earnings, and cash flows are very stable year to year, regardless of the economy. You're going to obviously be much more worried about those ratios for a very cyclical company whose sales and earnings tend to fluctuate, right? Okay, so that's financial health. Then the next thing they talk about in the chapter, and I think it's the last thing, it is the bear case. What is the bear case? The bear case, of course, bulls and bears. Bulls expect the stock to go up, bears expect it to go down. So the bear case is reasons not to invest in the company. What is the bear case? What are the reasons not to invest, or at least to be extremely cautious before investing in the company? And again, there could be a lot of reasons. It could be, new competition eroding their market share. It could be, a heavy debt load that might not be able to withstand an economic downturn. Might just be, management isn't managing the company very well. They've been failing on a lot of initiatives. They have a lot of problems right now, et cetera. Whatever it might be, what could be a reason not to invest in the company, or maybe even a reason to sell it short, in the hopes the price goes down. So that's the bear case. All right, any questions then I'll get everybody on here once. Any questions on any part of chapter 6? Okay. No questions? All righty then. Well, we'll move into chapter 7. I'll go back to this view. Okay, we'll scroll down, get some new people on there. All right. Chapter 7. So chapter 7 is the last one that is going to be on test 1. So it talks about analyzing a company's management, and so they mention compensation, character, and then they list running the company. Well, I thought, hey, if we instead look at, just call it, well, how well are they running the company, or how good are they running the company? If we just call that competency, then we got 3 C's, the 3 C's of analyzing a company's management. So I thought, hey, I'm going to call it, instead of running the company, I'm going to call it competency. So starting with compensation, first of all, the information on compensation can be found in the DEF 14A, otherwise known as the proxy. Okay. That's where, and what you're going to find if you look at a proxy, and you're going to, because we're going to look at one here shortly, what you're going to find is that it's very long and really long, and so you probably don't want to read everything word for word, but there are some things you want to look for. Okay, one of the things is, and he talks about this, he says, the author, I mean, when I say he, restricted stock and management compensation in the form of restricted stock is preferred over stock options. Why? Because with restricted stock, you share in the downside, and that's not necessarily the case with stock options. What do I mean? Well, let's say, for example, that a stock has an option price that was granted, options were granted to management of the company to buy the stock at a price of $20 a share. Okay, now those options at some point in time will expire. Well, let's say the current market price of the stock, all of a sudden it took this big hit And now the current market price of the stock is down to like $13 a share. Okay. Well, is management is only going to, those options are only going to be really worth anything to management if the price gets above $20 a share, right? Because that's the price at which they can buy the stock is $20 a share. So if the market price stays below 20, those options aren't doing management any good. So using stock options as compensation may encourage excess risk taking on the part of management. Because again, like in the example I just used, if the option price is $20 a share, but the current market price is only $13 a share, management might feel like, hey, we need to do something to try to raise the market price of the stock. Now, if our plan blows up in our faces, and instead of raising the stock price goes down instead of up, doesn't matter to us because we weren't going to make any money on these options unless the price went above $20 anyhow. So as far as our personal wealth, it doesn't really matter if the market price is $13 a share or $8 a share or $5 a share. We're only going to profit on those options if we can get the price above 20. On the other hand, if we have restricted stocks, shares of stock that we're just restricted in that we can't sell them yet, we know at some point we're going to be able to sell those shares of restricted stock. And certainly we're going to care whether those shares are worth $13 or $8 or $5, right? So in other words, with restricted stock, we do care if the price of the stock goes down. With stock options, if the stock is out of the money on those options, management may take excessive risks and say, yeah, if it doesn't work out and the price falls, it's not really hurting my wealth anyhow. So restricted stock definitely is preferred over options. By the way, I'm going to skip down here to this one. Long-term incentives for management should be preferred over short-term incentives. So incentives that say you've got to meet goals this quarter or this year, you know, are very short-term, and a lot of times management will do things to meet short-term goals, but sometimes it's at the expense of the long-term future of the company. Politicians do the same goddamn thing, you know. That's why I've always been in favor of term limits, because politicians know, hey, if I'm going to get reelected, I can't do something that's unpopular, even if I know, okay, it's unpopular because it's going to hurt the economy in the short run, but I know in the long run, it's going to help the economy. But if I hurt the economy in the short run, I'm not going to get reelected. So screw the long run. Let's just do what's best in the short run. Politicians make those decisions all the time. Very few of them are ever willing to stick their necks out and say, I'm going to do something unpopular for the long-term good of the country rather than just the short-term good. And again, I think term limits would go a long way in helping politicians to maybe be a little far-sighted than most of them are when how they vote on issues. Also, because shares are issued to management in the form of stock options or restricted stock, etc., the shares issued to management in any given year should not exceed 1 to 2% of the number of shares outstanding. Okay. So this is all stuff on management compensation. So let's look at, well, restricted stock versus stock options. Well, let's look at it. Are the incentives long-term, short-term, and so forth? And we can find that in that DEF 14A. Some of the things under character we can find too. For instance, there should be a preference that the vast majority of directors on the board of directors are independent and not, you know, don't work for the company or are not immediate family members of the CEO and things like that. you want to make sure is management candid about mistakes. You're probably not going to find that in the 14A. Related party transactions, that can be found there if there is any. Okay. And here's something else that you probably could find in the DEF 14A is the CEO and the chair of the board the same person. Generally, we would prefer that they be different people, okay? So that we have two different people at the top that, you know, both two different people at the top that are watching over the company and watching over, hopefully, shareholders' best interest. So let me do this. I'm going to minimize us again here, and we're going to go back to, so here was Home Depot. Now let me go back a couple links here to the, now as some 10Ks will actually have the proxy as part of the 10K. Let's just look and see if there's anything here under the proxy. Well, you do have information on directors, executive officers, and corporate governance, and executive compensation, which also, so for this part, they may have just copied the DEF 14A or proxy right into the 10K. Let's just click on this and see. Okay, directors, executive officers, and corporate governance. Information required by this item, other than the information regarding the executive officer set forth below, is incorporated by reference to the sections entitled Election of Directors, Corporate Governance, General and Audit Committee Report in our proxy statement for the 2020 annual meeting of shareholders. Which means, okay, that we're probably not going to have a lot of information here. Whenever they say incorporated by reference to those sections of the proxy statement, that typically means, okay, a lot of the information is not going to be in here. You're going to have to go see, like executive compensation. It's incorporated here by reference to proxy statement. Let's find the DEF 14A. What I'll do is go back here, go back a link again. Okay, and again, now, let's look for the most recent. DEF 14A, here we've got one. Here is, well, additional proxy soliciting materials in Rule 14A. Here's other definitive proxy students. I'll start with this one and then we'll move to that one if we need more info. So click on this. Here's the DEF 14A. Okay, investor fact sheet. Shareholder return principles, key performance metrics, etc. Oh, and here's where they talk about the proxy. Also, proxy is a way for investors, shareholders, to vote for various proposals for the corporation, as well as various directors who are up for re-election. Okay, so we can see this would be to elect directors of the company that are up for election. Also appoint KPMG, Pete Marwick as the auditing company. Cast an advisory vote to approve executive compensation. That was something that came out of the Dodd-Frank legislation after the economic crisis. The idea was, you know, some of these bankers were getting huge pay and taking maybe unnecessary risks and had to be bailed out potentially by the government. Now, I always kind of criticize that when I say that. Okay, I'm gonna, all right, right now I gotta I gotta, okay, because I need to talk about that just a little bit. I want to get everybody where I can see again. So I teach a course on the financial crisis, and in that course, I talk about the fact that it was, first of all, it was not just a bailout of the banks. It was a bailout of the entire economy. Because if the banks go down, the economy goes down, and unemployment skyrockets, et cetera, et cetera. So the bailing out the banks did bail out Main Street. Know that, number one. Number two, to say that taxpayers bailed them out in some ways is not 100% accurate. Why not? How much did TARP, which was the $700 billion package Congress passed for fiscal measures to bail out the companies hurting from the financial crisis, in some cases companies that maybe even helped cause the crisis. So that $700 billion of TARP money, how much did that eventually end up costing taxpayers? Whole $700 billion? Does anybody know? Okay, Sarah, no, not the whole $700 billion. Do you know how much it did? I think you're muted, Sarah.
I don't believe it cost them anything.
No, it didn't. Yeah. Did you take my class on the crisis, or was that financial management? Maybe I mentioned it.
I think it was in financial management.
Okay, yeah. Yeah. Ultimately, the government actually made money. The taxpayers made money on the bailout. They got back, first of all, $700 billion was never spent. They were authorized to spend $700 billion, Treasury was. They only spent, sorry, Sam, I'm just watching you make your bet there. They only spent about 460 billion, something like that, and they actually got back more than what they spent. So actually, ultimately, when they talk about those bailouts, ultimately that did not cost taxpayers a single dime. Also, something else you should know, there were some banks that were behaving very properly, never did anything bad, but just because they were large, they were told they had to take bailout. They weren't given a choice. And if you watch the movie Too Big to Fail, you'll see that. There were banks that definitely were not bad operators, were not bad apples, and they still had to take the money because the government told them to take it, some of that bailout money. Why? Because they said, if only some of you take it, then we're afraid depositors and investors are going to say, oh, the ones who took it are the bad banks, the other ones are the good banks. We don't want them to do that. So we're just going to tell all of you, you have to take it. So some of those big banks that took bailout money, in fact, did not do a single thing wrong. Okay, a lot of them did. Again, the bailout didn't just bail out the banks, it did bail out Main Street. And again, the other thing is, ultimately, it did not cost taxpayers. So when you hear about all these corporate bailouts and stuff, take that with a giant grain of salt. All right, let's see that. Okay, so back to here. Okay, election of directors. Let's look here and see what the qualifications are. Well, what I was really looking for, I'm going to minimize this here, guys. What I was really looking for is to see if that was going to tell us the independents. Oh, okay. Down here, they're talking. Our independent director nominees have a balance of tenure, age, and diversity, which provides our board with an effective mix of experience and fresh perspective. Whoops. Did I skip too far, or was that? Oh, maybe I didn't go down far. There we go. Average tenure, average age, etc. Director nominees. Here are all 12 incumbent board members. Now this is Home Depot, remember. That's generally good. They see a lot of companies will stagger elections for board members. They'll say, okay, a third of the board is, the board members are elected for 3-year terms. So every year, 1/3 of the board comes up for re-election at the end of every year. And, but what's preferred is if the whole board comes up for re-election each year. And that's what it looks like in this case, full board. And the board have recommended election of all 12 incumbent. Oh, they've recommended the election of all 12 incumbent board members who are up for re-election, but that doesn't mean they're all up for re-election. The board may have more people. Yeah, each of the 12 would hold office until the 2021 annual meeting. Okay, so maybe they are all. It does look like they all come up for election every year. And here's information on all the directors, audit committee report, shareholder proposal, response to the proposal. That's always kind of interesting, by the way, to read if you do. Here we go. Compensation, discussion and analysis. Okay. And here. So again, throughout 2019, executed against these strategic initiatives. So there's some highlights of performance, compensation philosophy, and objectives. Pay for performance. So we designed our compensation program for associates at all levels with the intent to align pay with performance. By doing so, we seek to motivate associate performance and enhance morale, which drives a superior customer experience. We believe this alignment encourages achievement of our strategic goals and creation of long-term shareholder value. Principal elements of our compensation program for executive officers are base salary, annual incentives, and long-term incentives. We use a number of financial metrics highlighted above, which drive shareholder value as a key performance metrics in our compensation programs. This congruency aligns both pay and performance and executive interests with shareholder interests. Following executive compensation report card highlights the alignment between pay and performance for each of these elements of our compensation program. 2019. Okay. Here's performance measures. What was the threshold? What was the target, the maximum, and actual on sales, operating profit, inventory turnover. Here we got our ROIC. That's another metric that affects compensation, the return on invested capital. 3-year average operating profit. Okay. Performance-based restricted stock. Okay. Stock options based on stock price performance. Annual grant with an exercise price of $189.25 was made on March 27, 2019. By the way, over here, we see how much each of them got performance as a percent of the target. And performance-based restricted stock awards, which comprise 30% of the annual fiscal 19 equity grant were forfeitable if fiscal 2019 operating profit had been less than 90% of the MIP target. Dividends on performance-based restricted stock grants are accrued and not paid out to executive officers unless and until the performance goal is met. Our equity awards have longer vesting periods than many of our peers, with performance-based restricted stock and stock options vesting over 5 years, and a performance shares cliff vesting after 3 years, which aligns executive officers' interests with the interests of our shareholders in the long-term performance of the company. That's all good. We do not provide tax reimbursements. All right. And somewhere down here, they're going to actually show each guy gets and so forth. Here we go. Base salaries, 1.3 million for the CEO, 840,000, et cetera. Well, then if you add in the incentives, et cetera. Now we're going to say, okay, at target performance, he gets 200% of base salary. At actual performance, he got, instead of that, he got 79.6% of that target performance of 2,070,000 added on to the 1.3 million. Awarded named executive officers annual long-term incentives consisting of 50% performance shares, 30% performance-based restricted stock, and 20% stock options. And again, you see the various metrics that had to be met. Value at the date of grant and value at the end of performance. Oh, by the way, shares earned, I saw that back here. Shares earned at end of performance, February 2nd, 2020. So they list all these shares that were earned. If you add that all up, would that equal more than 1% of the number of shares outstanding? Well, add those number of shares up and then go to the balance sheet or income statement, wherever they've got the number of shares outstanding, and see, did that equal more than 1 to 2% of the shares outstanding in the company? And again, you can see all kinds of information here about options vest 25% on each of the 2nd, 3rd, 4th, and 5th anniversaries of the grant date. Now, your summary compensation table. So total compensation, 2019, and it does show Craig Manier is both the chairman and CEO of the company. Got earned just under $11 million in total compensation. Richard McPhail, the CFO, just over $2 million. Executive Vice President of Supply Chain Product Development, 3.8 million almost, etc. Real terms of their agreements. Fiscal 19 grants and plan-based awards. Okay, so again, just giving you more information on the shares and options, etc. And I'm still trying to get down to if they're going to show us like CEO pay ratio. This is required to be in everything now. So they have to say how much the CEO made relative to the rest of the employees of the company, median paid employee. Okay, so there's the median paid employee. There's the amount that the CEO got paid. So the CEO got paid 481 times what the median employee with Home Depot made. That was also part of Dodd. And the other part of Dodd-Frank, remember there was the thing on director compensation here too, was shareholders can vote and take an advisory vote on the compensation plan. They can't say you can't do it. They can say, we don't like it and we don't want you to do it, and say that. Okay, now this is more things on voting for the meeting. Still trying to look for related party transactions and didn't see them on this one. So I'll back up. Was this one and yeah, executive compensation. You guys see anything on related parties? I don't see anything. Okay. Let me try going back to that other DEF 14A. So we clicked that one, and then this is additional definitive stuff. Okay. See if there's anything here on related. No, that's just the notice of the meeting.
I think there's a section called related party transactions. I just did a Control F to find it.
Oh, you did? Okay.
Yeah.
Well, so this was back on the other one we were looking at then. Okay, so back on this one, right? And you hit Control F.
Well,
and
I have the 2020 proxy statement pulled up. And when
well,
I
it doesn't
had that,
show anything for related parties on this one.
I think
Okay.
it was the document you were just in.
Oh, yeah, I guess I got to open it first. I think it's, yeah, I think it's this one. Okay, now Control F and related party transaction. Okay. So,
Well, for some reason, I had 3 results. Maybe I was in a different thing.
well,
I don't
transactions, I mean, that's probably not going to help. Related party transactions. Okay, related party transactions.
And yours only shows 1 of 1. Mine shows, I have 3 results. I don't know why.
Really?
Yeah, mine said HD 2020 proxy statement.
HD 2020 proxy statement. So Home Depot.
Eh.
And you got it off, you know, so it's the same one then. Proxy statement and notice of 2020 annual meeting of shareholders.
Let me check. Thursday, May. Yeah, mine looks the same.
Oh,
I don't know.
yeah. Well, anyhow, something to look for, see were there any material. Usually they're all kind of boilerplate language. So I'm going to get back to seeing everybody here. In other words, a lot of times they're all going to say very similar things about if there is related party transactions, they're looked at by our board. We have a committee of the board that looks at those transactions, and they're only, you know, approved if the company believes that we're getting just as good a deal as if we were working with non-related parties.
I put it in the chat if that, I don't know.
Oh, okay, a chat for our meeting here. Okay. And, oh, cool. Okay. Thank you. Yeah, related party transactions, the NCG committee, NCG. don't know what NCG means. Anyhow, reviews all related party transactions, governance, I suppose, non-corporate governance committee. I don't know, something like that. Reviews all related party transactions involving a board member, executive officer of the company, subject to Section 16 of the Exchange Act. Help identify related party transactions. Each director and executive officer completes the questionnaire, requiring a disclosure of any transactions the person or any member of his or her immediate family has or will have with the company. General counsel also conducts an independent investigation. In accordance with its charter, the committee reviews, approves, ratifies, or rejects any transaction involving a related party that is identified. In approving, ratifying, or rejecting, the committee considers such information as it deems important to determine. Yeah, so like basically it'll allow us to say something like, was it, if somebody acted for a company that served as a supplier to the company, were we still getting the best product at the best possible price? That type. So yeah, search out these things when you write your report. Again, you don't have to read word for word, line by line, the entire proxy. It would take too long. But yeah, if you can just search for some of the key things: independent director, related party transactions, compensation. Again, is it short term, long term? I was at one of the things, and I know some of you know that I every year have taken students to the annual shareholders meeting for Berkshire Hathaway in Omaha. And the day before the Berkshire Hathaway meeting, we go to Creighton University where they have a value investing panel discussion. And one of the analysts that was on the panel for this discussion was checking out a company that they'd been scheduled to meet for, with this company at, an analyst meeting, whatever. And she was talking to the CEO and said, what incentives does the company use for your compensation? It said, all the incentives are based on one thing: sales growth. And she knew right then, as I would know, do not invest in that company. When all they care about is sales growth at the expense of everything else, including profits, cash flows, how much, think about it. Hey, I might grow my sales 5% if I double the amount of equity in the firm by selling a bunch of, stock. Hey, if it's going to take a lot, double the investment in the firm to get a small bump in sales just to grow my sales, am I really adding value for shareholders? The answer is no. But so the idea of, or if I make an acquisition to grow my sales, I may or may not have added value for shareholders. So just the idea of growing sales does not automatically add value for shareholders, especially if you have to issue, new stock, raise more equity, whatever, in order to make the acquisition or do whatever else it takes to grow your sales. Are the investors getting the return they can require? If not, it's not a good deal. So if your only incentive to management is sales growth at the expense of increasing value for shareholders, that is a recipe for disaster for shareholders. That would be a firm. Okay, well, let's get back down here to whoops, this thing. We already kind of went through. Is management candid about mistakes? I mean, if you follow a company close enough, you know the news about the company, you know that once in a while a company is going to make mistakes. Where would they admit to those mistakes? In that letter to shareholders in the annual report. If you look at the annual report that Warren Buffett sends to shareholders for Berkshire Hathaway, in every letter he talks about mistakes that he has made in the past for Berkshire Hathaway. Is management honest and candid about that? If they try to gloss over their mistakes or not even talk about them at all, that's certainly a red flag. Doesn't mean you shouldn't invest in the company. Well, maybe not necessarily, but it certainly should come up as a red. Finally, competency. Does management follow through on major initiatives? Again, if you look at the shareholders letter, in the letter to shareholders, I should say, in the annual report for, say, 3 years in a row, and 1 year management was all excited about this new initiative, and then all of a sudden the next year or a couple of years down the road, it doesn't even get mentioned. Well, either it didn't work out very well, they didn't execute it very well, or it didn't get executed at all. So that would be something to look for. Watch out for significant share count increases, because again, maybe management is being overly compensated with stock and stock options. Of course, you would prefer increasing returns on assets and equity over time. If there's increases in sales, are they from an acquisition? If so, did the company pay a reasonable price? And again, that's obviously a judgment call. But when we get into valuation, you'll be able to decide for yourself. Well, is it within the realm of what's reasonable? Does the company provide enough information to analyze the business? You know, if for instance, you know, a lot of companies will break down their business by sectors of the business. They'll break it down by geographic area and say, okay, you know, here's where, you know, how much sales we had in this territory. Here's how much we had in this territory, and so forth. Do they break down profitability and margins by product or product category? Sometimes they do, sometimes they don't. A lot of times when they don't, if asked or pressed on it, what they'll tell analysts is, we don't want to give away too much information to our competitors. Well, okay, but you know, if it also makes it more difficult to analyze the company, then maybe that should be a red. Does management spend enough on R&D? Again, one of the ways of trying to increase profit is cut costs, and one of the costs that's easy to cut is R&D, which may help your short-term profits, but a lot of times if you're cutting on research and development, that's not going to help long-term profit. Does management keep the debt level reasonable, or is the company overburdened with debt? And finally, does management, when they buy back stock, they do it only when the stock price is low, or at least at a reasonable price? They're not overpaying when they buy back the stock. For instance, again, Berkshire Hathaway, Warren Buffett, originally they came out and said, well, we are going to buy back stock anytime. He went into this whole thing in a shareholder letter and said, you can never know for sure what the intrinsic value of your stock is. The intrinsic value being the present value of all future cash flows for the company. Says, you know, you never know what your intrinsic value for stock is, but you estimate it. And he says, we're convinced based on our estimates that when our stock is trading at less than 1.2 times book value, it is trading significantly below intrinsic value, and we will buy back shares. Well, of course, as soon as he comes out and says this, what happens to the price of the stock of Berkshire Hathaway? Bam, jumps up to 1.2 times book value, because everybody's like, well, if it's worth less than that, he's going to buy it back because he considers it undervalued. And this is the great Warren Buffett. So you know, after that, they got rid of that little clause saying, we're only going to buy back stock when the price is 1.2 times book value or less. They now just say, when we think it's significantly undervalued relative to intrinsic value, we'll buy it. Okay. Anyhow, I think this whole review sheet is a pretty comprehensive review for you for the test. Any questions about anything we covered tonight? So again, the test will be available Friday, beginning Friday morning at 8 a.m. Now you can take it anytime Friday or Saturday. Just make sure it's, remember, you do only have 3 hours time you start the test till you finish it. And also it does have to be submitted by midnight Saturday night. Any questions about the test coming up here in a couple of days or anything we went over? No, here, I'll get everybody on here. So any questions from anybody?
Rob?
Yeah, show.
It's not really related to class, but I have some personal finance questions. Can we talk after class? Thank you.
Absolutely. Okay. Anybody have any class related questions? Well, maybe the class is interested in your personal finance questions. I don't know, Joe. Can you ask it without giving away too much personal information?
Yeah. Well, so a couple questions. So I have some
If
index.
you're interested, hang on. If you're not, you have what?
So I have some index funds, ETFs,
Okay.
and then most of them are, like high dividend yield or like. So basically trying to get market average for long term so I can just leave the money in there, right? But
That's your goal.
Yeah.
Yeah. The one thing about dividend, so ETFs generally follows a very specific index that follows very specific rules.
Mhm.
About what is included and what's excluded, when things are bought, when things are sold, etc.
So
One thing about dividend ETFs is, some of the stocks, it depends on what specific index they're following. And because here's the thing, a lot of companies have had to cut dividends because of the economy being what it is. And so the ETFs are what we call passive management. Actually, there are a handful of actively managed ETFs, exchange traded funds. Most ETFs are passively managed, meaning they've got specific rules for how they're invested, et cetera, and they don't deviate. At times like this, having ETFs where they're passively managed is okay for part of the strategy. I think it's good to have some active management too, because active management is going to seek out those companies that are vulnerable to a downturn in the economy, those companies that may have to cut dividends and things like that. So honestly, I tell most of my clients it's probably good to have a mix of both.
So my main question was, let's say I'm going to keep those as it is, but I have one sector fund which follows info technology.
Okay.
And then
Good sector to be in.
So
the only sector to be in lately.
so they look like they are doing really good, but how
They have been, yeah. Now the market took a bit of a plunge today. I don't know where it closed at, but I know as of mid-afternoon before I had to deal with some back stuff on a motel deal.
Those index funds, how do you know when to take profit or just let it ride?
Well, as a long-term investor, if you're invested in a good diversified mix of funds that have good strategies, I'd just stay fully invested. Now, if a strategy no longer seems like a good strategy, like an ETF starts performing badly, or even an actively managed mutual fund, you know, a bad quarter I wouldn't worry about. A couple bad quarters I wouldn't worry about. You know, but you know, after a couple 3 years, something's not is really subpar in its performance. That's probably the time to get out of it. I wouldn't take profits unless you've got something better you think you'd invest in, because remember, long term, you don't want to try to time the market. You know, and long term stocks are going to go up. So you don't want to have cash on the sidelines if it's money you don't need for a long period of time. You're a young guy, even if the market tanks again. I mean, and we know it could happen because, I mean, like I say, it dropped a bit today. COVID cases are coming back up again as everybody's opened up. I initially wasn't too worried personally about that until I saw that hospitalizations are starting to come up in a lot of places too. That's more concerning to me, because I think if just the number of cases go up, and by the way, Trump's plan to fix that is less testing. If we don't want to see more cases, how about we do less testing? We thought that was a joke. It turned out, yeah, maybe not, because now the federal government is only going to help fund testing now through the end of this month, and then they're done. But anyhow, but the hospitalizations is more concerning to me, because I'm like, if young, healthy people are getting it and they're mostly asymptomatic or mild symptoms, I don't think that's going to have a big impact on the economy. I don't think it's going to cause shutdowns or consumers to stay home. If hospitalizations are going up, that is going to cause governments to maybe start getting a little more restrictive again with activities. It's going to cause consumers to maybe stay home a little more. So yeah, the market could tank again. It could tank big time. As a young person, you got time to ride it out. So as long as it's a good strategy, and generally high dividend stocks are a good strategy long term. The only problem is this time around, so many of those high dividend companies did have to cut their dividends. But otherwise, that generally, though, that's a good strategy. Companies with strong balance sheets, good cash flows, strong balance sheets, not overburdened with debt. That you know, and especially if they're companies that are profitable and can grow their sales and profits, that's the way to go. I heard somebody on CNBC say something today that made a lot of sense to me. They said, if technology doesn't make sense in this market, then nothing makes sense in this market. Because people are saying, well, tech stocks, yeah, everybody thought, well, yeah, they had their big run when the market was going up, but everybody thought, well, boy, they're going to get banged when the market goes down. No, when the market went down, tech stocks continued to go up, and in some cases, even a lot more. And so I don't think you can go wrong with technology as a sector. I wouldn't have it as 90% of your portfolio, but you know, yeah, I think a fair chunk, you know, 10, 20%, even 20% of your portfolio in technology, I don't think is too heavy in my opinion.
Right.
Any other questions? And remember, you can go on Morningstar and look at those specific ETFs and see, you know, how they've done historically, what they're, you know, rated and things like that.
How accurate are those fair value in the Morningstar?
Now the fair value estimates are for the individual stocks,
Yeah.
rather than, yeah. How accurate are they? Well, it's obviously what Morningstar believes is the fair value of the company. It is based on what we teach in finance, which is present value of the future free cash flows. That's how Morningstar determines their target range. A lot of analysts may use that as part of their target price, but they'll also look at momentum and, you know, look at PEs and things like that. Morningstar's fair value estimate is almost entirely based on discounted cash flow now. So it's as good as their assumptions are about the future cash flows of the business. I do remember, I can't remember the name of the company, but one time I kept hanging on to a stock because Morningstar thought it was worth way more than it was trading at. And it kept going further and further down. And I'm like, well, Morningstar is sticking with this price. Until all of a sudden one day they didn't. And then Morningstar said, we've reevaluated the fair value estimate. Now it's bam, way low. And I'm like, oh, well, I guess I can sell it now. So they're not always right. And no analyst is always right. But I trust Morningstar a lot. I also look, Tip Ranks is a site that I use a lot, TIP Ranks. And they will tell you how analysts, you know, what their price target is on stock. In fact, you can also just go to finance.yahoo.com. And if you put in a company, the target price of all estimates combined, all analysts, I should say, combined, the target price will pop up for you. And you can see what they think. So that's something else to go by along with the Morningstar fair value estimate. But I will say this, who was it I was looking at the other day? I'm like, gee, I really like that company. I think maybe I'm going to buy them. I looked at Tip Ranks. Tip Ranks target price was a little below where the current market price was, but I'm like, yeah, I still like the stock. Then I checked Morningstar and they gave it 1 star because they thought it was way overvalued. And so I didn't buy it. What the hell was that? I put a lot of trust in Morningstar. Not all of my trust in there, but certainly some.
All right.
Yeah. Any other questions?
I'll stop here.
Oh, yeah. What did you say? You let Jean-Pierre ask anymore? John?
Okay. Yeah.
Questions?
Rob, I have a question. Okay.
What kind of beer am I drinking? It's Busch Light.
Okay.
I knew that was your question.
So, Rob,
Yes.
on some balance sheet for different company,
Mm-hmm.
yes, I saw, yeah, I see some like security, yeah, we said security marketable is on the like as a short, yeah, a short-term assets. So
What was it? Marketable securities?
yeah, marketable, yeah, marketable.
Mhm.
So what is it exactly? So because I'm trying to relate it to our to this class.
Mm-hmm.
Oh, yes, I want
Yeah.
to get better
So-
understanding of that.
So marketable securities would be your near cash assets, things like short-term CDs or treasury bills that mature in a short period of time. So they're near cash assets. They pretty much treat them like cash.
Okay, so it's like a short-term, short-term stock.
Well, short-term stock, no. Marketable stocks will never be in marketable securities because they don't
Okay.
mature. Yeah,
Okay.
stocks don't mature. If a security is in marketable securities, that means the investment the company made was in, like, again, short-term treasury bills, CDs, something, commercial paper, something that matures in a very short period of time. Yeah.
Okay.
So yeah, if a company invests in long-term bonds or stocks, that'll show up under long-term investments. That'll never show up under marketable.
All right. Okay. Okay. So, but our class is security.
Right, securities analysis.
Yeah.
So we're talking about really when we say securities, it's more stock analysis on doing an in-depth dive on an individual company. That's really what it is.
Okay.
Yeah.
Thank
So,
you.
yeah, the title of the course, I can see where that's a little confusing on the title of the course, but
Yeah.
we're actually looking not at a lot of different types of securities. We're looking at one type of stocks, and we're looking at analyzing the individual company to determine whether or not you would want to buy its stock. Yeah.
Okay. Thank you.
Yep. Okay. Anything else? All right, I'm gonna grab some dins, but well, good luck on your test Friday, and I'll try to. If anybody has any trouble getting into the test or something, please email me right away. Let me know. I'll be checking to make sure nobody seems to be having any problems, because every once in a while, I don't know if there's something I do goofy or it's Brightspace or, well, I'm sure it's me, but there have been times when people couldn't access the test and I thought I had everything set to go. So if for some reason, if you're one of those, it's going to be first thing Friday morning doing the test. If you have any problem access. Oh, and one other thing I should say about the test. It is going to be a combination, multiple choice questions. Well, maybe I'll just make it all multiple choice. I haven't done it yet. I mean, I have former tests that I'll be doing a version of. But in the past, I've had multiple choice and some short essay or even problems. So there could be, let me leave it at that. There could be short essay questions on the test, but there won't be anything on the test that is not at least referenced in that review sheet. Okay.
Yeah, if it's all multiple choice, we get instant feedback and you don't have to grade anything.
Well, I was thinking about that. That was part of what was going through my mind, you know. Yeah. I'm like, oh, okay. I could save myself a lot of time in grading if I just turn the problems into multiple choice questions instead, you know. So, yeah. I might do that if I feel like I can. Yeah. It's probably going to be all multiple choice, but are you guys going to hold me to that now that I said it? Yeah. Okay. All right. It's all multiple choice. I've just made the decision. I'm going to make it because I know the other questions I was going to ask in the essay form and whatnot. And I'm like, I think I can do those in multiple choice. Yeah, we'll make it 100% multiple choice. Okay, anything else? All right, good luck on the test. Have a great week, and I'll see you next week.
See you, Rob.
Bye,
Thanks,
everybody.
Rob. Bye.
You bet. Thank you guys for being here.
Yeah.